What if you could get Bitcoin-level excitement with dividend checks? Sounds like a dream, right? MSTY, YULTI, and JEPI, 3 ETFs promising fat yields and wildly different bets. Some people see dollar signs, others see red flags. But either way, you can't ignore them. So let's dig in and see which one might actually pad your pockets or blow them up. Now, first things first, what are we even talking about here? Because let's be honest, if you just glance at these ticker symbols, they all look like some weird alphabet soup. MSTY, ALTI, JEPI, you'd be forgiven for thinking they're the names of new K-pop groups. But no, they're exchange-traded funds. And not just any ETFs, they're specialized income machines designed to lure investors with the promise of steady checks, big yields, and maybe even a chance at wealth building. Here's the twist though. They don't make that income in the old school way, like collecting dividends from Coca-Cola or clipping coupons from bonds. Nope. These guys are built around options. More specifically, covered call strategies. If that already sounds like Wall Street mumbo jumbo, here's the plain English version. Imagine you own a stock. Then, instead of just sitting there hoping it goes up, you rent it out short-term by selling someone the right to buy it from you at a set price. They pay you rent for that privilege. That rent is called a premium. You pocket that premium no matter what happens. If the stock takes off like a rocket, well, you miss out on some of that upside because you already promised to sell it at a lower price. But if the stock just drifts sideways or goes up a little, you still keep the premium. Multiply that strategy across dozens or hundreds of positions, and boom, you've got yourself a high-yield ETF. Sounds clever, right? But clever doesn't always mean safe. Let's take these funds one at a time, because each one has a very different personality. Spoiler alert, one is an adrenaline junkie, one is a calculated daredevil, and one is the responsible adult of the group. MSTY is officially called the YieldMax MSTR Option Income Strategy ETF. Already sounds fancy, but what does it actually do? Well, it's handcuffed to MicroStrategy stock. Yes, the company run by Michael Saylor, who has basically turned his business into a Bitcoin vault. MicroStrategy isn't just a software company anymore, it's practically a giant Bitcoin ETF with a corporate logo on top. Here's where Misty gets spicy. The fund doesn't just sit there holding MicroStrategy shares. It flips them into a covered call machine, constantly selling options on that single stock. Which means two things. 1. You, the investor, get exposure to one of the most volatile Bitcoin proxies on Wall Street. 2. You pocket those sweet option premiums as income. Sounds amazing, right? But hold up. Here's the trade-off. Your upside is chopped off. If Bitcoin moons and MicroStrategy stock rockets, you don't get to ride the full elevator to the penthouse. You get a partial ticket, capped by the options you sold. And on the flip side, if MicroStrategy falls off a cliff, and let's be real, it's done that more than once, you take the full fall. The premiums soften the blow, sure, but they won't save you from a 20%, 30%, or even 50% crash. In other words, MSTY is like strapping yourself into a roller coaster that pays you every time you scream. Fun until the tracks snap. Then you've got ALTI. This one's the Yield Max Ultra Option Income Strategy ETF. The name screams extreme, and honestly, it kind of is. But instead of betting everything on one company like MSTY does, ALTI spreads its wings a bit. It spreads its bets across multiple names, selling covered calls on a broader basket of stocks. That makes it feel safer than MSTY. A little less like walking a tightrope blindfolded over Niagara Falls, and a little more like bungee jumping with a backup cord. But don't kid yourself, it's still aggressive. The whole play is about squeezing juicy option premiums and turning them into chunky distributions. If you like the idea of wild income checks but don't want your fate tied to one Bitcoin-obsessed CEO, ALTI is your flavor. Still risky, but with training wheels. If you're still hungry for high yield but want to spread your risk a little, ALTI might be more your style. You'll still get chunky distributions, and you won't have your fate tied to just one company. Think of it as betting on the whole race instead of just one horse. Still risky, still aggressive, but a touch more forgiving. The trade-off is that you're paying more in fees, and the strategy is still volatile by nature. It's like playing poker with friends. You can lose, but the game isn't all or nothing, like throwing it all on red at a roulette table. And if you're someone looking for actual reliability, the kind of income you can plan around, JEPI is the one that fits. It won't blow you away, but it won't blow you up either. It's the kind of fund retirees love because it feels like a paycheck. You can actually sleep at night knowing JEPI will do its thing, churn out steady income, and avoid the chaos of chasing extreme highs. You won't get rich overnight, but you won't wake up broke overnight either. That trade-off appeals to a lot of people, which is why JEPI has billions under management and a loyal fan base. But now let's face the million-dollar question head-on. Which one will make you rich? Honestly, the answer is none of them. At least not in the way people imagine. If you're hoping MSTY is going to transform your portfolio into a millionaire's dream, you're betting on fireworks that could just as easily explode in your face. ALTI might give you strong gains if you time the market perfectly, but it's still built on a fragile foundation. And JEPI, while stable, is never going to skyrocket you into sudden wealth. It's built to be a steady paycheck, not a lottery ticket. That's the uncomfortable truth. These funds are tools, not miracle machines. They're like cars. MSTY is the sports car with a nitrous boost. Fun, dangerous, and not at all practical for daily use. ALTI is the turbocharged sedan, fast, flexible, but heavy on gas and maintenance. JEPI is a minivan, safe, reliable, and designed to get you where you need to go without drama. Which one's right for you depends entirely on your road ahead. If you're chasing thrills, MSTY might scratch that itch. If you want excitement, but with a little more safety net, ALTI might be the one. If you're thinking long-term income you can depend on, JEPI is your steady ride. Another way to think about it, MSTY is like sitting at the high roller table in Vegas. You could walk out rich, or you could be begging for cab fare home. Alti is more like a risky poker game. You might have a good night, you might not, but at least you're not putting it all on one spin of the wheel. And JEPI is like a boring savings account with a bonus. Nobody brags about it, but it gets the job done. The truth is, most investors don't need miracle machines. They need tools that fit their actual goals. That's where these funds need to be seen for what they are. MSTY is a thrill ride. Alti is a middle ground. JEPI is a stable paycheck. None of them are a one-way ticket to riches. They can all play a role, but only if you know exactly what role you need them to fill. If you treat them like lottery tickets, you'll be disappointed. If you treat them like tools in a toolbox, you might actually come out ahead. And that's really the takeaway. Don't chase the shiny yield numbers like they're golden tickets. Ask yourself instead, what am I actually trying to achieve? Do I want thrills? Do I want balanced aggression? Do I want stable income? Your answer tells you which ETF belongs in your portfolio, if any of them do. So now the question is back on you. Which one would you pick? Would you strap yourself into MSTY's roller coaster? Would you settle into ULTY's wild but slightly safer ride? Or would you choose JEPI's steady paycheck path? Ever feel like picking an ETF is a little like standing in front of a vending machine with 3 snacks you've never tried? Let's explore SCHD, VTI, and VOO. VTI is the all-rounder kid in school. Plays basketball, gets decent grades, knows everyone. It's the go-to for a diversified investment. VOO is the popular one. The kid who hangs out with the cool crowd, dresses sharp, and likely ends up valedictorian. It's an attractive choice for investors. At SCHD, the wise old soul, the reliable friend who gives you sound advice and always pays you back. It focuses on quality dividends. VTI is like ordering the whole menu. It covers myriad US companies, giving you instant diversification. The cool part about VTI is that it's simple. It's like going to an all-you-can-eat buffet. You know you're not going to love every single dish. But on the whole, you're full, happy, and satisfied. You're getting the complete picture of the US economy in one bite. The returns over the years have reflected that. Nothing crazy flashy, but steady growth that keeps up with the overall US market. Now let's talk VOO. This one is laser-focused. It tracks the S&P 500, the 500 largest companies in America. If VTI is like owning every shop in a giant mall, VOO is like only owning the anchor stores. You're not worrying about little kiosks. Because of that, VOO often performs just a hair better than VTI. The mega-cap companies drive most of the market's returns. You're not as diversified as VTI. If the big players stumble, VOO feels the pain harder. When big tech sneezes, VOO catches a cold. If you believe the US economy will keep being powered by these giants, VOO feels like a safe bet. It's like backing the star players of a championship team. Then we've got SCHD, the dark horse, the dividend machine. It doesn't care about being trendy or chasing flashy stocks. SCHD punts for companies with a track record of paying and growing dividends year after year. That's its superpower. It means stability. It means cash flow. While the market swings, SCHD quietly hands you a check. Money you can spend or reinvest. SCHG is like owning a fruit tree. While VTI and VOO focus on height, SCHG keeps dropping apples into your basket each season. That steady harvest is a huge deal for people wanting income, whether retired or simply enjoying dividends showing up. Dividend-paying companies are often more disciplined. They've weathered recessions and still reward shareholders. Investing in businesses that have proven they can handle storms makes SCHD a comfort blanket when markets get rocky. If the economy thrives, VOO likely has the edge with mega-cap companies driving growth. Apple, Microsoft, or NVIDIA lift VOO, making it glow. These corporate giants pull the market wagon. VTI won't be far behind with all the big names of VOO, plus thousands of smaller companies riding the growth wave. Dividend-paying companies are often more disciplined. They've weathered recessions and still reward shareholders. Investing in businesses that have proven they can handle storms makes SCHD a comfort blanket when markets get rocky. If the economy thrives, VOO likely has the edge with mega-cap companies driving growth. Apple, Microsoft, or NVIDIA lift VOO, making it glow. These corporate giants pull the market wagon. VTI won't be far behind with all the big names of VOO, plus thousands of smaller companies riding the growth wave. Dividend-paying companies are often more disciplined. They've weathered recessions and still reward shareholders. Investing in businesses that have proven they can handle storms makes SCHD a comfort blanket when markets get rocky. If the economy thrives, VOO likely has the edge with mega-cap companies driving growth. Apple, Microsoft, or NVIDIA lift VOO, making it glow. These corporate giants pull the market wagon. VTI won't be far behind with all the big names of VOO, plus thousands of smaller companies riding the growth wave. A lot of investors build a core position in VTI or VOO for long-term growth, then sprinkle in SCHD for stability and income. It's like building a team with star scorers. Let's talk about the fees. VTI and VOO have low expense ratios, basically pennies on the dollar. SCHD is slightly higher, but still cheaper than most actively managed funds. In a roaring market, VOO could edge out the others due to its growth focus. But in a choppy market, SCHD provides stability with dividends. VTI remains in the middle, giving you exposure to everything. It's not the top performer, but won't leave you out in the cold. There's no absolute wrong choice among these funds. The real question is, which one suits you best? Growth, income, or diversification? VOO is your star player, the one scoring the big points. SCHD is your reliable veteran who knows how to keep calm under pressure. VTI's your deep bench, giving you coverage across every position so you're never exposed. Before you chase performance charts, ask what you actually want out of investing. Are you chasing long-term growth or immediate income? My gut, if growth stocks keep powering ahead, VOO will look like the champ. If dividends stay in demand, SCHD is going to surprise. So, which one's your pick? Are you team growth with VOO, team everything with VTI, or team dividends with SCHD? Picking ETFs might not be as exciting as chasing meme stocks, but this is how wealth is really built. Slow, steady, reliable. Let's talk ETFs, but not the kind that put you to sleep faster than a PowerPoint presentation. This isn't going to be one of those dry breakdowns that make you question every life choice you made. If you pick the wrong fund, you might find your money leaking away like socks in a dryer vortex. We're going deep into the heavyweight matchup, SCHG versus QQQM, classic growth versus tech dominance. By the time we're done, you'll understand why your choice shapes your financial future. Here's what usually happens when people start investing. They open their favorite trading app, type in best ETF, and start scrolling. They see charts, they see percentages, they see arrows, and without thinking twice, they just pick the one that went up the most last year. I used to think I was clever chasing one-year returns, but focusing on past performance alone is like using Google Maps with half the information missing. Returns are just one piece of the puzzle. You've got to pop the hood and see what's really driving these ETFs. First up is SCHG, the Schwab US Large Cap Growth ETF. Picture it as a seasoned fisherman casting a wide net across America's 750 largest companies. What makes it stand out is balance. SCHG isn't just tech-heavy. It spreads your money across various sectors, creating a sturdy, all-weather foundation. Now cue the spotlight for QQQM, the Invesco Nasdaq 100 ETF. If SCHG is a buffet, QQQM is an exclusive Silicon Valley dinner party. It focuses on just 101 non-financial giants: Apple, Microsoft, Nvidia, Amazon, Meta, Costco, Netflix, companies shaping our lives. Investing in QQQM is like buying a front-row ticket to the future with exposure to AI, cloud, and cutting-edge tech. But that concentrated power also makes it more volatile. Thrilling when markets soar, but bumpier in downturns. Now let's talk about something most investors overlook: fees. They're like termites that can eat away at your returns. SCHG charges an ultra-low 0.04%, while QQQM's 0.15% is nearly 4 times higher, compounding into thousands over decades. If two investors both put $10,000 into their ETF every year for 30 years, the one paying lower fees could end up with tens of thousands more. Cost efficiency in investing is like getting front-row concert tickets for half the price, simply because you paid attention. Owning an ETF doesn't automatically mean diversification. SCHG and QQQM appear diversified, but share many of the same top-heavy holdings. Over half of both ETFs are dominated by the same 10 mega-cap companies, which can expose your portfolio to the same risks. A bad quarter from a giant like Apple can ripple across all growth-focused ETFs, impacting your returns. The real differences between SCHG and QQQM show in the final 10 to 15% of their holdings, with SCHG including more diverse sectors. SCHG includes financials like Visa and MasterCard, and healthcare like Eli Lilly, diversifying your exposure to various growth engines. QQQM focuses on main tech sectors, offering greater volatility with substantial swings, perfect for those seeking substantial growth. SCHG delivers a balanced approach with steady returns, funding your entertainment and health advancements through diverse sectors. Both SCHG and QQQM have produced about 18% annual returns, effectively doubling investments over 5 years. However, QQQ tends to outperform over a 10 to 15-year span due to its tech-heavy focus on innovation and growth. With technology as the driving force, Consider your investment strategy and your tolerance for market turbulence. But higher returns come with higher risk. The market isn't a steady climb. It's a roller coaster with sharp drops and wild turns. In 2022, inflation fears and rising rates made growth stocks less attractive. Both SCHG and QQQM took a hit. SCHG fell about 36%, and QQQM sank roughly 32.5%. This shows that growth doesn't always mean smooth sailing. Moments like that are the real test of an investor's discipline. Surviving the downswings builds true wealth. Most beginners sell during crashes, locking in losses, but those who stay the course tend to come out stronger. History shows every single crash in the last 100 years has turned into a new high. Understanding volatility is crucial. SCHG's broader diversification means it weathers downturns better than QQQM, which can be more exposed to tech sell-offs. When the market rebounds, QQQM often bounces back faster because its core holdings, like Nvidia, Amazon, and Apple, lead the next rally. How do you use this information for a smarter portfolio? The key is understanding your time horizon, goals, and emotional tolerance. If you're young with decades before retirement, volatility isn't your enemy, it's your friend. Those dips are discounts on long-term growth. If you're mid-career and can't afford to lose 40%, consider a more stable core. A 60-40 or 70-30 split might make more sense. As you approach retirement, preservation becomes the name of the game. Protecting what you've built matters more than chasing extra percentage points. You might keep QQQM as a smaller slice, 10% or 20%, to retain growth potential, while most money could sit in SCHG or dividend-paying ETFs like SCHD or VIG. The right choice isn't the same for everyone. It's about building a mix that reflects your timeline and temperament. The hardest part of investing is mastering your own behavior. The biggest threat to your portfolio isn't inflation or interest rates, it's you. Panic selling during correction and waiting for things to calm down can hurt you. The market rewards the calmest, not the smartest. Consistency beats brilliance. Investing steadily and ignoring the noise often leads to better outcomes than chasing trends. If you invested $10,000 into the S&P 500 in 2003 and stayed invested through 2023, you'd have around $70,000. But if you missed just the 10 best days in those 20 years, your return drops by nearly half. That's the cost of impatience. The worst thing you can do is panic sell at the bottom. Those moments often set up the biggest gains. Time in the market matters far more than timing the market. Focus on how long you stay invested. When you combine SCHG and QQQM, you blend two philosophies: structure with innovation and balance with potential. Markets will crash. Headlines will scream. Talking heads will predict doom. Understand how to react when things go wrong. Volatility isn't a signal to run. It's a feature of the system. Learn to see those moments as opportunities. Whether you're leaning toward SCHG for stability or QQQM for innovation, the real key is patience. Investing is about stacking base hits. Show up month after month and let compounding do its work. There's no single winner because the right choice depends on your values, stability, or acceleration. If you're the type of investor who wants to set it and forget it, SCHG is hard to beat. Its ultra-low fees and diversified sector exposure make it reliable. SCHG offers consistent performance, making it the kind of ETF you can hold for decades without losing sleep. It's the steady engine of your portfolio. Because it spreads your money across many different industries, SCHG is less vulnerable to single sector meltdowns or sudden market shifts. On the other hand, if you're hungry for maximum growth, QQQM is your ticket. It focuses on tech and disruptive innovation for bigger swings. When tech is booming, QQQM tends to outperform broader growth ETFs like SCHG, offering potentially higher rewards. If you're okay with a bumpier ride and can stomach the volatility, QQQM can supercharge your returns and give you exposure to leading businesses. You don't have to pick one. The smartest portfolios treat SCHG and QQQM as teammates. SCHG gives you structure, stability, and cost efficiency that every portfolio needs. QQM adds the spark and upside potential that can make a good portfolio great. Blending them gives you a resilient portfolio that takes advantage of bull markets. Think of it like building a car. SCHG is the reliable engine, QQQM is the turbocharger. Fees are the single most underestimated factor in long-term investing. A 0.10% difference could mean the difference between retiring with comfortable or life-changing money. If you invest $10,000 a year for 30 years with an 8% return, a 0.15% fee leaves you with about $1.09 million. With a lower 0.04% fee, that amount can increase to about $1.12 million, which is an extra $30,000. Investors can't control market fluctuations, but they can control investment costs, which compound over time. Many believe owning multiple ETFs means diversification. But if they hold the same top stocks, you're just paying more. SCHG offers broader sector exposure, unlike QQQM's tech focus. Together, they enhance your growth potential. Most people think they lose money because of bad investments. In reality, they lose money because of bad decisions. They panic sell during market drops. They buy into hype when things are overpriced. Your job isn't to predict those swings, it's to survive them. If you can resist the urge to sell during a 30% drop, and if you can stay invested through the noise, you'll outperform the vast majority of investors. SCHG and QQQM aren't just investment vehicles. They're behavioral tools that test your patience and reward your discipline. With the right mindset, one focused on decades, not days, they become powerful engines of wealth creation. If you want a buy-it-and-forget-it ETF with minimal fees, broad diversification, and reliable growth, SCHG is the clear winner. If you want to lean into innovation, embrace volatility, and maximize your exposure to tomorrow's companies, QQQM is the more aggressive choice. To take advantage of both philosophies, own both SCHG and QQQM. SCHG gives a calm, predictable foundation that grows steadily, while QQQM brings excitement and potential for outsized gains. Fees matter more than you think. Diversification is more complicated than it looks.
Imagine you woke up one morning with $100,000 burning a hole in your investment account. You want to put it to work, not for a quick flip, but for real, sustainable growth over the next 20 years. Which ETF do you choose? Today, we're going head-to-head. SCHD versus QQQ versus JEPI. And we're going to simulate what happens over 2 decades. Let's start with the fundamentals of each strategy. SCHD, Schwab US Dividend Equity ETF, focuses on high-quality dividend-paying US companies. It tracks a dividend-weighted index and selects firms with strong balance sheets, consistent cash flow, and sustainable dividends. SCHD's long-term average annual return since inception is around 12.04%. Its expense ratio is extremely low, just 0.06%. That combination makes SCHD a favorite for investors who want both yield and capital appreciation. The fund holds around 100 stocks, carefully selected through a rules-based approach that emphasizes dividend sustainability and quality metrics. Then there's QQQ, the Invesco ETF that tracks the Nasdaq 100. This fund is essentially a bet on technology and innovation. It's heavily exposed to tech giants like Apple, Microsoft, Amazon, and Google. QQQ offers high growth potential, though with more volatility. Its expense ratio is about 0.20%. Because of its tech-heavy exposure, QQQ has historically outperformed many broad market ETFs during bull markets, but it's also taken deep hits in downturns. The concentration in the top 10 holdings means that a handful of companies drive most of the returns, which can be both powerful and risky. Finally, there's JEPI, the JP Morgan Equity Premium Income ETF, launched in May 2020. It uses a covered call strategy combined with high-quality equities to generate monthly income. It's designed to provide current income with some potential for capital appreciation. Its expense ratio is relatively higher, around 0.35%. The payoff? JEPI yields consistently, offering a smoother stream of cash flow, but its growth will be capped by the options it sells. The fund actively manages both its equity holdings and option overlay, making it more hands-on than traditional passive index funds. Now let's set some assumptions for our 20-year simulation. We'll begin with a starting principal of $100,000, assume dividends are reinvested for SCHD and QQQ, while JEPIs are partially reinvested. We'll also assume no additional contributions. This is a pure lump sum test. Based on historical performance and forward-looking expectations, SCHD can reasonably be modeled at 10% annualized returns, QQQ at 12%, and JEPI at 7% when combining yield and moderate growth. If you invest $100,000 in SCHD and let it compound at 10% annually with full dividend reinvestment, by year 5 it grows to around $161,000. By year 10, roughly $259,000. By year 15, about $418,000. And by year 20, approximately $673,000. That's more than a 6-fold increase, a strong combination of dividend compounding and capital appreciation. The beauty of this approach is that those dividends keep growing year after year, creating a snowball effect that accelerates wealth building over time. With QQQ, assuming 12% annualized returns and reinvestment, by year 5 your investment grows to $176,000, by year 10 $311,000, by year 15 $552,000, and by year 20 around $979,000. Under that growth scenario, your $100,000 nearly becomes $1 million. That's the power of compounding in tech-driven innovation. The higher growth rate may seem modest compared to SCHD, but over 2 decades, that extra 2% makes an enormous difference in final wealth. JEPI, with a 7% annualized total return, compounds more modestly. After 5 years, $100,000 becomes about $140,000. After 10 years, around $196,000. After 15, $274,000. And by year 20, roughly $382,000. The difference is that JEPI's income stream pays you monthly. For investors relying on cash flow, that consistent distribution can be a huge benefit, even if the overall growth is slower. Over those 20 years, you could have collected more than $150,000 in distributions, which represents real cash that many investors use to fund their lifestyle or reinvest strategically. Each fund carries its own distinct personality. SCHD balances growth and income beautifully. It's composed of quality companies with strong fundamentals, offering steady dividends that can grow over time. It's a favorite among long-term investors who want to see reliable compounding without the wild volatility of tech stocks. The fund's focus on dividend aristocrats means you're investing in companies with proven track records of shareholder-friendly policies. QQQ, in contrast, is an adrenaline rush for your portfolio, highly rewarding but also capable of testing your nerves. It's concentrated in tech and innovation, meaning that during bull markets, QQQ can explode in value. However, it's also prone to sharp drawdowns. Those who've stayed invested through downturns have been rewarded handsomely, but timing mistakes can cost you dearly. The psychological challenge of watching your portfolio swing 20 to 30% in months can't be underestimated. JEPI plays a different game altogether. It's for the investor who wants to generate income now. By writing covered calls, JEPI effectively trades some of its future growth potential for present-day cash flow. This makes it ideal for those nearing or in retirement, where the focus shifts from building wealth to maintaining lifestyle through steady income. The monthly payment schedule aligns perfectly with how most people manage their expenses, creating predictability. Let's discuss taxes and cash flow. SCHD and QQQ dividends are typically qualified, which means they're taxed at favorable long-term rates. JEPI, however, generates much of its income from option premiums, typically taxed as ordinary income, which can be higher. This makes JEPI more tax efficient when held in accounts like IRAs or 401ks, while SCHD and QQQ can be more flexible across taxable and tax-advantaged accounts. Understanding these tax implications can save you thousands over a 20-year period. When it comes to cash flow, JEPI stands out. Investors often use it to fund monthly expenses or reinvest part of its income. SCHD and QQQ, meanwhile, build wealth through compounding. Reinvested dividends and growth appreciation are their engines. In the long term, reinvestment of dividends makes a profound difference. Even modest dividend yields, when compounded over decades, contribute significantly to total return. What's surprising is how compounding trumps yield alone. JEPI might pay you every month, but SCHD and QQQ's reinvested dividends could easily outgrow JEPI's total value over time. Volatility, often seen as a risk, can actually be an ally in growth-focused funds, like QQQ, provided you stay invested. Market dips allow reinvested dividends to buy more shares at lower prices, boosting long-term compounding through dollar-cost averaging. However, for income investors, consistency often outweighs compounding. JEPI's smoother returns and regular payouts can help prevent panic selling during downturns. Behavioral finance plays a huge role here. Many investors stick to their plan more reliably when they see consistent income, even if total returns are lower. This behavioral advantage often translates into better real-world results than theoretical projections suggest. Now, let's compare how each fits different investor profiles. If you're in your 30s or early 40s with a long time horizon and appetite for growth, QQQ's potential to nearly 10 times your money in 20 years makes it extremely compelling. For those in their 40s or 50s looking for balance, SCHD offers the perfect middle ground. Solid returns, lower volatility, and growing dividends that can eventually replace income. For retirees or income-focused investors, JEPI delivers peace of mind with its monthly cash flow and reduced downside risk. Risk can never be ignored. SCHD's risks revolve around dividend sustainability. Companies can cut dividends in recessions. QQQ's risks are tied to its concentration in high-growth tech. Regulation or valuation corrections can hit hard. JEPI's risk is opportunity cost. In roaring bull markets, it lags behind because its covered calls cap upside. Each ETF is shaped by a different philosophy, so diversification across them may actually be the best solution for most investors. Imagine a portfolio split evenly. 1/3 SCHD, 1/3 QQQ, 1/3 JEPI. The SCHD portion gives dividend growth, QQQ fuels capital appreciation, and JEPI provides cash flow stability. Together, they form a diversified engine that can perform well across different market cycles. This blended approach reduces the risk of being overly concentrated in any single investment philosophy while capturing unique benefits. It's also crucial to note the impact of fees. Over 20 years, even a 0.3% difference in expense ratios compounds into thousands of dollars. SCHD's 0.06% expense ratio gives it a massive efficiency advantage over the long term. QQQ's 0.20% is reasonable for its performance, while JEPI's 0.35% is on the higher side, justified somewhat by the active management and option strategy. On a $100,000 investment over 20 years, these fee differences could mean tens of thousands in final wealth. When you model how these ETFs behave under real-world economic cycles, the best ETF for you depends not only on returns, but on how you experience those returns. During the 2008 financial crisis, dividend-paying stocks recovered faster. Companies that maintained or raised dividends acted like a lighthouse in the fog. The Nasdaq fell almost 50%, but investors who stayed invested caught one of the greatest bull markets in history. In 2020, the pandemic sent QQQ crashing 30% in weeks, but it skyrocketed soon after, as tech became the backbone of lockdown life. QQQ doubled within a year if you stayed invested. SCHD fell less sharply and continued paying dividends. JEPI's income strategy would have kept monthly payouts coming, allowing investors to reinvest when everything felt uncertain. Each strategy provided a different kind of psychological comfort during that unprecedented moment in market history. In 2022, rising interest rates slammed tech valuations. QQQ dropped nearly 30% while JEPI barely blinked. SCHD quietly outperformed both thanks to its defensive dividend stocks. This highlights a key insight. The winner changes with the environment. Over 20 years, all three have a place. QQQ shines when innovation leads. SCHD shines when fundamentals matter. JEPI shines when markets chop sideways and volatility spikes. This cyclical outperformance teaches us a timeless investing truth. There's no single ETF that wins all the time, but the one you can stick with will always win over time. Consistency beats perfection. That's why a balanced approach, owning a mix of SCHD, QQQ, and JEPI, often outperforms the investor who jumps from one to the next chasing performance. The psychological stability of a diversified approach keeps you invested. Most investors overestimate how much timing matters and underestimate how much time matters. If you missed the 10 best days in QQQ over the past 20 years, your return would have dropped by nearly half. If you missed the 10 worst days, you'd be rich. But no one can predict them. The better plan? Stay invested through both. This is why buy and hold investing continues to outperform active trading for the vast majority of investors. Let's shift to psychology. Investing isn't just math. It's emotion, behavior, and discipline. The ETF you choose must fit your temperament. QQQ requires emotional resilience. Watching a $100,000 investment fall to $60,000 in a tech crash and still holding, that's not easy. SCHD offers comfort during those periods because dividends still arrive even when prices drop. That dividend check becomes a psychological anchor. JEPI takes that further, offering monthly income that smooths the ride. Behavioral economists call this the income illusion, when steady cash flow feels like progress, even if your portfolio's total value temporarily declines. It's not a bad thing. In fact, it's one of the reasons income strategies help people stay invested. If your ETF pays you every month, you're less likely to panic sell. This behavioral edge often matters more than theoretical return advantages in the real world. Let's talk about real-world outcomes. If you had invested $100,000 in SCHD 20 years ago and reinvested every dividend, your annual dividend income today would likely exceed $10,000. That's a 10% yield on cost, a reflection of years of dividend growth. QQQ's dividend yield remains tiny, but your capital appreciation dwarfs it. JEPI might still hover near that original investment size, but it could have paid you $5,000 to $7,000 per year in cash flow the entire time. Suppose your goal is to live off investment income starting at age 65. Using today's yields, SCHD pays around 3.5%, JEPI around 8 to 10%, and QQQ less than 1%. That means $1 million in SCHD might pay you $35,000 per year, JEPI $80,000 plus, and QQQ just $10,000 unless you sell shares. The catch? SCHD and QQQ will likely keep growing, increasing income potential each year, while JEPI's payouts might stagnate if markets flatten. Taxes play another silent but massive role. Dividend income from SCHD and QQQ is mostly qualified, meaning it's taxed at lower rates. JEPI's option income is usually ordinary income, which can reduce after-tax yield in taxable accounts. That's why many financial advisors suggest holding JEPI in tax-sheltered accounts like IRAS, while keeping SCHD or QQQ in taxable ones for better efficiency. There's also inflation to consider. Over 20 years, inflation quietly erodes purchasing power. Growth ETFs like QQQ act as inflation hedges because the underlying companies can raise prices and grow faster than inflation. SCHD companies also tend to increase dividends annually, protecting your income's real value. JEPI may lag because covered call income doesn't naturally adjust for inflation. That's another reason to blend strategies for comprehensive protection. Behavioral discipline remains the silent driver of returns. Many investors lose more to emotional decision-making than to fees or volatility. The temptation to sell QQQ after a crash or chase yield with JEPI can erode long-term results. Consistency and patience always win the compounding game. When researchers analyze real investor behavior, they find something shocking. The average investor earns 3 to 4% less than the funds they own simply because of emotional decisions. So, who wins after 20 years? Statistically, QQQ likely produces the highest final balance at around $979,000. SCHD's combination of income, growth, and low cost creates the most livable wealth at approximately $673,000. JEPI remains the quiet enabler at $382,000, the one that gives financial confidence through cash flow, even when markets misbehave. The smartest move? Don't treat this as a contest. Treat it as a construction project. Build your wealth like an engineer. SCHD as the foundation, QQQ as the steel frame, JEPI as the finishing layer. Together, they form a portfolio that can endure recessions, reward patience, and support your life for decades to come. At the end of the day, $100,000 is just the starting line. The real question is, how much of it will still be invested when the next crash hits? The investor who masters patience and discipline will find that whether it's SCHD, QQQ, or JEPI, the path to freedom isn't about predicting markets, it's about staying the course through every twist and turn. If this helped you rethink your ETF strategy, hit the like button, share this with someone building their portfolio, and subscribe for more deep dives into investing logic, long-term wealth design, and the psychology behind money. Because at the end of 20 years, it won't be about which ETF won, it'll be about whether you did.